What is your top takeaway from this data that we're seeing this morning?
Well, so as you mentioned, that GDP was a bit weaker than expected, but everything else a bit stronger. But what is not reported today, but was reported before, of course, was imports. Imports was much stronger than expected. So I suspect that the net trade was contributing probably negatively to growth in this quarter. That, of course, is also a manifestation of domestic demand recovering. So overall, I think this picture it still holds that China's recovery has continued in the third quarter, and especially with domestic consumption, retail sales picking up, I think going forward that bodes well with continued recovery in the fourth quarter and next year as well.
Okay, and when we look at the export part of the economy, which really fueled a lot of the rebound, particularly in the first few months after the pandemic, is there a concern? Are we seeing any evidence that the continued pandemic situation in Europe and the US, which of course remains very severe indeed, is having any drag on exports, or will do at least in the next few months towards the end of the year? Is that a potential drag on China's exports?
I think there's some risk that if with the new wave of COVID-19 that demand recovery for Chinese exports in Europe and U.S. actually fades somewhat. So there's definitely that danger. But however, even in the second quarter of this year, China's exports held strong when the global economy went into a deeper recession. So I think that we may not see exports as strong as 10% growth in the remainder of the fourth quarter. Actually, most likely will not because of also the base effect. But I think the Chinese exports into next year will remain quite strong and continue to be a source of growth for China in the coming months. And that's because China was able to supply the world the medical supply, medical equipment, the electronic goods that actually saw increased demand. And now despite the new wave of COVID, actually external demand, global demand for products such as clothing and so on, the usual goods have started to recover, and that is also positive for China.
So it's Rish in Hong Kong. Tell me a little bit. I mean, is this getting reflected in the currency? The onshore yuan has been gaining ground. I think it's about 6.6% or thereabouts since the middle of May. Is it all baked in, this good news story out of China, economically speaking?
I think a lot of these strong fundamentals on the balance of payments, on strong trade and so on, indeed has been reflected in the strength of the currency. And of course, another factor is the interest rate differential. China or the PBC has not really eased nearly as much as other major central banks, and rates have come up since May and remained elevated. And China, of course, has continued to try to open its domestic financial markets and attract more inflow. So all these three factors, and also the fact I think that the U.S. at this moment at least is still holding on to the phase one trade deal. So there's no major bad news on the tariff front. There's a bit of a stability there for the time being. So all these factors support the currency. And we think these factors will continue to support the currency in the coming months. So we think it's going to be probably range-bound, or even have a bit more potential to for the CNY to grow a little bit stronger.
And all of this against a backdrop which is so contrary to what the central government and authorities did after the GFC in terms of stimulus. There's not been that huge pumping of money into the system. So how would you describe the state of China's finances?
Right. I think that, after the GFC, China really stimulated massively, and there, of course, were significant negative consequences as well. So that includes the excess capacity buildup and non-performing loans, and that threatened the health of the financial system. So I think the authorities were more cautious this time around, especially since the COVID shock and trade war came after a few years of, very concerted effort to try to contain leverage. So that is still quite in the authorities' consideration. So therefore, I think they focused on trying to normalize activities with controlling virus this time, and also with more limited or more moderate policy easing. And so as a result, I think they given up the growth target for this year, and the priority is really stability of growth of the financial system, of the currency, and so on. I think that is really behind the policy mix that we have seen.
And part of the question around stability then, Wang Tao, is linked to the job situation here in China. Do you have a clearer sense now of how many of those who lost their jobs after the pandemic have been put back to work? How much repair has been done to the labor market here in China?
Right, that's a very good question with not great answers because of lack of data. But we did track work resumption rate through the spring, and we discovered that by end March, about 70 to 80 million people were not working in 6 major sectors, including industry, construction, retail, wholesale, and so on. And that number quickly declined to 35 to 40 million by end April, and then 20 million by end May. We haven't got additional data since then, but I would imagine that that number had continued to decline. I don't think we are fully back to normal because some small businesses did go out of business or closed and so on, so that is hard to track. But there has been a very quick sort of mend in the labor market, and that I think should continue. And that, just to go back to a bit on the financial situation as well, of course, some of, what has happened this year, the slowdown in the economy, the closure of some business, and the increased leverage, nevertheless, that happened, did increase the financial risk as well. But given the rebound in the economy and moderate easing by the government and still a lot of inflows, that leaves a lot of liquidity in the system, I think the financial risk is not imminent.
And also, how does all of this fit into this narrative of this policy of dual circulation, and how will that figure when it comes to the next 5-year plan?
Yeah, so that's a great question. I think, given what has happened with external shock, with also U.S.-China relations unlikely to improve in any significant way, so China can no longer rely as much as before on external demand. Even though China still very much wants to integrate in the global economy, is accelerating opening, it has to turn to domestic sources for more growth, for more domestic demand, but also productivity growth. So that's the meaning of dual circulation. So I think that would mean a lot more, push ahead with the reforms such as hukou reform, SOE reform, lower the entry barriers for private sectors, and so on. At the same time, on the supply side, in terms of economic structure, they need to guide the economy more towards services. There's going to be emphasis on digitalization, and also infrastructure enables such transformation in the next 5-year plan. There's going to be focus on building up domestic capabilities in technology because China is facing restrictions. And also there's going to be areas about more greener development because of China's announcement of net zero in 2060, which requires already quite aggressive actions in the next 5 years. So all of this, a slower growth, transformation of the economic structure, the greener development, emphasis on technology, on digitalization will all be featured, I think, in the next 5-year plan.